event. So just give us maybe a couple of minutes and we'll start right away. And we'll start soon, not right away.
Sounds good.
So for everyone who has already joined, we will start the event in a minute. I know that Gary is still admitting the audiences into our event. All right, so it's time to commence our event. Edith?
Hi, how are you?
Okay, great. So just a few logistic things. So for you guys who are listening in, can you just mute yourself? And if you do have questions, can you post that into the chat room? I will try my best to look into the questions. And we'll try to address all the questions as we go, as many as possible if we can. I think in the past few events, we have very robust questions from the audiences, and I think the feedback was really good. So without further ado, we shall start the event right now. So Edith, thank you very much for being able to join the Asia CEO community. So I'm really excited for today's event because I've known you for some time and I know you have a breadth of experience. Your experiences, kind of like span from being an entrepreneur, and then you have become a venture capitalist with 500 startups for some time, looking after the greater China, and correct me if I'm wrong, and you were kind of exposed to Asia Pacific as well. And then you now kind of like relocated to the Bay Area here and kind of raised capital. I think that is really kind of like fascinating, the way that you have progressed in your career. Can you, I don't want to be the person, talking about everything about your background. I think you would be the best person to talk about it. Can you share with our audience your background and also about Raise Capital? And a lot of our audiences, their background is they're themselves entrepreneur, or they're thinking about entrepreneurship. I think you will be a really good person to share this experience because you've been entrepreneur yourself. So tell us about your background and also about Raise Capital.
Yeah, so my background is I actually started as a developer many years ago. You obviously don't want me to build code anymore, but literally, like when I have free time, I actually still like to sort of build website landing pages, like really just like more for fun, to test our idea. I spent mostly enterprise software 10 years in Siebel, Oracle, Autodesk, very enterprise focused. And then after 10 years, I realized I really wanted to build something that I can touch and feel and can really use. So in between, long story short, I sort of dabbling into Dolphin browser, which is mostly on the Android. I actually ran into the founder. He's a Chinese entrepreneur originally from Wuhan. And long story short, he basically showed me Dolphin and I said, why do I care? And he convinced me that I should join him and start this thing together. And the way that he convinced me is basically he's going to be the next Jerry Yeung from Yahoo. We all happen to have the same last name. My Yeung is spelled in Cantonese sound, so that was Yeung. But having said that, I decided to join, and that was a really amazing experience because Dolphin was actually invested by Sequoia China. Yes. I think Wendy spent a long time with Sequoia, and so Zhou Kui was actually on our board, and it was a really amazing experience because we basically went hyper growth during the early days in mobile. So it grew from nothing to 150 million install, and then ended up sold it to a Chinese gaming company called Changyou. And after that, that's really when I actually have a lot of experience going back and forth, sort of between having most of the development team in Wuhan and Beijing, but the go-to-market is all mostly in the US. But we also went all over the world trying to do mobile carrier deals. So that was actually a really, really fun time. And then after we sold to Changyou, I realized I really wanted to do more we're actually, during Dolphin, I was very lucky, did a couple of angel investment that's all in the mobile space. And some of them got acquired pretty early on because it was strategic for certain bigger companies. So I thought I wanted to do more. So I joined 500 Startup because I like doing early stage. 500 Startup is like out of Silicon Valley, very, very international. So I joined 500. And part of those times I was also overseeing sort of 500 Greater China portfolio. I think when I was there, we'd done about 40 companies. I would say China, we did okay, but for Hong Kong, we actually did Pernetics, David Cook. Hong Konger, and very, very supportive of Hong Kong. So particular focus on helping founders over there. And so now with raised capital have a lot to do with lesson learned from 500. So I invested in 2 unicorn. One is Agora.io, also a really great classic cross-border China-US story, Shanghai and Silicon Valley. It went public in June last year. And then also Solana. Solana is actually a crypto project, but also now worth about 3 to 4 billion. So these coupled, as much as I can say, oh, now I invested in unicorn. But at the end of the day, I realized, you know what, like if you don't own enough, you don't have enough skin in the game. You can basically, it's purely just bragging, right? And when we doing early stage, we go in so early, you spend so much time with the founder. And so Raise is really much on more classic VC where, we wanted to lead rounds. We want to own at least 10 or 20% in terms of equity ownership. Have a lot to do with the lesson learned from my previous fund. So that's me.
So I kind of wanted to go back a little bit to when you were being an entrepreneur and when you were doing Dolphin. When was that? And did you think that the time back then kind of helped propel the company forward and make it become kind of successful? And actually, before you even answer that question, I'm going to share my screen in respect to the deck that we're going to look into today. Hold on, let me see. Can you guys see it? Can you guys see my deck?
Yeah.
Okay, awesome. So before we get to the next slide, so talking about Dolphin, do you think the timing actually helped the company grow? And did you think that the timing kind of like enable you to kind of be able to sell the company at that time?
Oh, for sure. I think everything has to do with, well, of course, if you ask, always the founders is most important. But having said that, it's really all about timing of the market. So Dolphin started when there was only like a few hundred apps on Android. I don't think you even remember those days. And so like and then also the timing was with Android as a mobile OS, it was up and coming, but it wasn't dominant. And now, as much as obviously is between iOS and Android, but Android is basically Mac over versus PC. Like Android is the PC for mobile world, and started really early. And also it was around the time where Google have a lot of struggle between the Android team and the Chrome team. So the mobile experience on the Android phone really was subpar. So we were addressing a very specific white space that, was it on purpose? In some sense is definitely a big bet towards Android is going to take over. Yeah. So in many sense, I think, I'm sure, Wendy, you have a lot of talk around what, oh my God, like the pandemic, COVID also in an amazing accelerator for many technical, like of the tech industry. Just look at the stock market. So I think everything is about timing, but also of course take the right person to sort of be able to ride a wave, to be a good server. But if there's no wave, it's actually really tough, particularly for tech.
Mm-hmm. Now that you're in raise capital, I noticed that, I'm not sure whether these investments are done by raise capital or this is just the investment you have done over your career life. Kind of wanted to explore a little bit about that. Excuse me. Like, what do you see in these startups? And what are the things that attract you to them?
Yeah, so many lessons learned. This is a short list of like the investment that I've done in at 500. So I have so many stories to tell, but maybe I can pick a couple. There's one of obviously my favorite is Agora.io. Not only because they went public, have a lot to do with. It's one of those classic story, great cross-border story that don't necessarily come along that often. So Tony was the former CTO of YY. So YY is a very popular, sort of like Twitch, but for China. Been around forever. And a lot of young people will basically go on and watch people play games or watch them to sing songs. Sort of the older days of Douyin and TikTok, but in China for a long time. And so he has a really great expertise in terms of scale up large concurrent users, particularly with voice comment, but for consumer. So built upon his experience with Agora, with YY, he decided to build something where to make it as a service. So if you want to do voice chat or video chat, they definitely directly compete with Twilio. But I actually think that the use cases in China is even more diverse because just to start with, China is 3 or 4 times of the population of the US. So the scale is just crazy. So he, I think like just him plus the understanding of scalability. And even though like, I think at the time when he launched probably 7 years ago, the concept is a novelty. Like why would I want to embed like voice or video chat within my own business? Like, why do I need it? And now pretty much thanks to COVID, I think in 2020, the revenue, don't quote me on it, although it's all in the S1 anyway, the revenue in 2020 literally like triple the year before. So the pandemic really helped accelerate, and a lot of their customers are embed video chat within education company, within dating, within gaming, and it just makes sense because now everybody's stuck at home, and if you do customer service or you do sales, like other opportunity where this become essential rather than in the past it's nice to have. And I don't think this behavior is going to go away because now it's pretty much become part of somebody's life. And this is not just for China, it's also for the US as well. And no business would allow COVID to happen to them again. So this is going to be part of the operation. So super excited about Agora. I have many more, but I don't want to hijack this whole conversation in talking about one company. So
no, but I think you touched on a really good point because like everybody is kind of affected by the pandemic to some extent, right? But if you look at it, one of the silver lining from the pandemic is that people realize a lot of things can be done virtually. And it also opened a lot of I guess, make people more open-minded and give people a renewed perspective of a lot of things, how things should be done. Like in the past, people would say, hey, I can't learn piano through Zoom, but now the people could do it. So I guess like companies have also been looking for engineers and designers beyond their geographic locations. Do you see this as the new normal, or even like along a sustainable trend? And do you factor that into your investment consideration?
Yeah, so by the way, I'm still sitting at my house in San Francisco, and we've been doing this investing over Zoom for now over a year. I couldn't imagine. About 3 months in 2020, with being stuck at home, we internally we built. Well, actually, we use Notion actually to keep track of all our deals, and we started a new tracking indicator, which is distributed yes or no. Basically, just asking the team, where are you, and where's everybody, and pretty much 100%. If it's not 100%, at least like 99% of the teams that we have talked to, which we talked to hundreds, like in the last 12 months, they're all distributed. So I think just to begin with, we better get, as an investor, we better get used to that. The company that we're looking at, they are actually very comfortable. Imagine, especially I focus on more on the enterprise infrastructure, means on a daily basis, I'm talking to the most exoteric developer, or people really just prefer to like hide themselves and sit in the garage and never see the light of day. So they are actually really happy. They're made for the pandemic because they don't have to go out and see people. And now I think it's a really great thing in some sense, where now they have the excuse to really literally, and when I was preparing for this, I start thinking, you know what, like in the past, and Hong Kong obviously, or Asia have different pocket of engineering talent, but even in the Valley, it's not uncommon to see, let's say you have a sales and marketing or CEO maybe sitting in Silicon Valley, but Canada, especially sort of the Waterloo, University of Toronto, the Canadian actually done a really good job of subsidizing hiring for tech talent. So I see a lot of like sort of US, Canada, US, Ukraine, US, Russia, US, Israel. Those are all like hot spot in terms of engineering talent. For Asia, I often hear good things about Vietnam. There are actually a lot of really great, I guess because of the Vietnam War or something, many of them actually get scholarship to come to the US and study and then incentivized to go back. So I hear good thing about that. Nowadays, some of my Chinese teams will tell me that they're hiring in Taiwan. I'm like, why do you hire in Taiwan? And because there's not that many competition. There's not a BAT in Taiwan, right? So it's actually cheaper to hire in Taiwan than mainland China. I'm like, wow, interesting. So you sort of see like these pockets around the world start coming up, and it's great for our companies because as long as they're good at remote managing distributed team, I think is a great trend for us to pay attention to.
I think you touched on a really good point, because for a lot of places or locations in Asia or Southeast Asia, the country itself might not have a big enough market for the startups. So for a lot of these people who aspire to be entrepreneurs, like, you know, they can in fact just join a company that's outside of that location, correct?
Yeah.
But at the same time, they could also explore beyond talent beyond their own location. If they have a problem with recruiting talents, they could just go beyond that location.
Yeah, totally. It's a great trend. I was talking to this friend of mine, just joined Facebook from Apple. And I said, how do you even get on board? And they're like, no, I already got everything. Everything is done online. Onboarding is done online. Interview is done online. I think, you know, if the big tech companies in Silicon Valley is getting used to this, and some of them basically been told that, particularly the Twitter and Square, you never have to come back to the office again. so I think this is definitely a trend to stay.
Yeah, that's really interesting. Before we get to my next question, I wanted to touch on a few of these investments whereby you have mentioned that they've been acquired, you know, by a different company like Apple or Pinterest or Mapbox. Like, you know, like for example, Csuite Labs and Chirp that's been acquired by Apple. You have like Flexi and Human. Can you kind of share with the audience, why do you think they are attractive to acquire like those companies? And for entrepreneurs who are thinking about their own product and the potential for exit, you know, or potential to be acquired or to potential to be IPO, what should they be focusing on when they're thinking about that?
Yeah, to answer your first part of the question on why did they buy, I think that when a big company thinking about a new market or a new product direction, they have to decide, right? They basically is it faster for me to go to market to build my own, or is it faster for me to buy an existing team, already have the product that I want built, or already have the market that I want? The most well-known classic example, obviously, will be Uber tried with China, didn't really quite work out, but they did a deal with Didi, and they did the same thing with Grab. That's interesting. There's this basically sort of like a market grab. And then they end up basically eliminate the Uber app in both of these regions. So that's pure sort of a market land grab. But most of my investment, including the Sil Lab and the Chirp and Human, those are more for a technology, a product, and also people. So, and the term sometimes, although in these few cases, some of them are for that reason, some of them are not. For Chirp's case, they have very specific IP that the acquirer really wants, and they already filed the patent. And plus, it was a husband and wife team. They are both PhDs. It's just very, it's expensive to hire these talents to begin with, not let alone they have IP. Was the revenue very high? No, but sometimes like when you have certain things, which by the way, like if you guys are helping your own portfolio company to contemplate these, and actually most of these bigger companies are quite open, the public company, in terms of direction that they want to go, because it's all in their quarterly report, right? We're looking into, Apple is looking into autonomous car, or like Microsoft now looking into more enterprise. So therefore they bought a GitHub for billions and billions of dollars, or looking into sort of the networking and whatnot, and they bought LinkedIn. So a lot of these direction, except I still don't get why Microsoft want to buy TikTok. But other than that, most of the tech companies are quite clear about the direction of product. So it's just a matter of understanding your investments and where it sits in that particular like technology realm. So yeah, hopefully that answers your question.
Interesting you talk about TikTok, because I know you have shared your view about TikTok on CNBC. Do you see continual cross-border collaborations and technology influence beyond the border? Because I know TikTok, it started in China, but then it's now so global. Like it's a phenomenon in the United States as well. So what are your insights on that?
I think TikTok is exception to the rule. And I have to say, like before TikTok, I had some friends in Facebook will constantly ask me about what's happening with WeChat and really want to learn what they're doing. And even though I worked on a cross-border company, China market is so big. 99.999% of the Chinese startup really don't need to even think about overseas market at all, because China market is just so big, and there's really no need to cross border because it takes so much energy, particular go to market, different engineering team and everything. So, and plus, it's great to see now in the US there's a new administration. It's unclear how the new administration, how friendly it would be towards Chinese companies. But I think most of the Chinese companies and investors that I've been friends with for a long time are taking a more cautious and conservative attitude. So if you think about it, right, cross-border mean a lot of things. We've always been cross-border for our exit anyway. Most of the Chinese companies go IPO on NASDAQ or New York Stock Exchange. That's been going on for a long time. But even that, in 2020, you start seeing many of the Chinese companies are actually now dual listing in Hong Kong. Good for Hong Kong. but I think more and more of the investor even encouraging their own Chinese company to list on in Shanghai or Shenzhen. And so that's on the exit side. But for go-to-market, what TikTok went through is insane. Like the other way around, I mean, hey, you can argue that, you know, Facebook, Google all block in China as well. So like when you are trying to grow a business and you have to kind of think about these geopolitics, it's tough. So, and plus TikTok really haven't even, we're around for many, many years. And I remember when Cao Yi was still at Sequoia, China, he mentioned this, and then he invested when he started Source Code. I didn't get it. Why in the world would you invest so much on a news app, which now morphed into TikTok and Douyin, which is amazing. But that's rare, like exceptional. I think many of our investment depends on where you focus on. Just China and US alone is such a big market. Even you use enough already to go a huge exit. So I don't recommend that for everyone.
We have a question from the audience. I'm just going to ask it right now. It's the question is, can you summarize the various categories of venture capital organizations or venture capitalists that exist nowadays based on the type of companies they invest in? And I think the question is really about, you know, what are the typical venture capital from out there and the types of stages that they invest into? And how would you describe raise capital? Do you consider yourself as early stage, late stage, or growth stage?
Yeah, it's a great question. And by the way, these days, because the valuation is getting more and more expensive. So today, like a Series A could be today's seed stage could be a Series A 10 years ago, and have a lot to do with because, and by the way, don't forget, if you look at Amazon, is worth 1.5 trillion today. So everything is relative and is getting higher and higher. So, so for us, we focus on early stage, early to A, but mostly early stage, like seed. And when I an enterprise, very enterprise infrastructure focus. What's that mean? What's that mean is, and usually most of the fund will talk about what stage and what geography. They may or may not talk about vertical that they focus on. But let's say a big fund like Sequoia is, you know, you have big enough to invest in everything, right? And be able to build a big enough of a team where you can hire expertise in different vertical and industry. Because at the end of the day, particularly for venture capital as an asset class, is really about going in early. You don't see a lot of traction, and also like very much paying attention to market trend. I have a really good conversation with Harry Mann from Matrix Partner a couple of weeks ago. They are getting into space and food tech and biotech. I'm like, hey, I know you for a long time. I know you don't know space, but hey, you know what? There are talents that you can hire. And if your fund is big enough, then you can afford to do that. For us, we're a $125 million fund. We're not investing in space. Right? I don't mind going, but we don't have enough dry powder to invest in that, such a big investment, even for a seed. So therefore, you will see smaller fund like ours usually will pick certain domain expertise. What I do see sometimes is biotech and healthcare. Often you see like sort of just very, very focused on this industry or vertical alone. Sometimes I do see, let's say, maybe fintech sometimes, but otherwise, most of the enterprise for us, we want to be, you know, focused enough, but don't kind of lock ourselves into like such a small niche, because it's diverse. Like you want to diversify your portfolio, which means most of the normal fund will be at least 30 to 40 investment per fund, regardless of what size you're in. So therefore, in our head, it'll be like, I need to focus on an area where we have enough expertise. There are thousands of companies where we have enough to pick the 30 or 40 companies. I think in the past, and then also kind of think about which market you want to focus on. Wendy, like you talk a lot about product market fit, founder market fit, but also investor market fit. For us to be able to pick the right person, do we actually understand the market more horizontal or vertical enough? If you're into biotech and you have many years experience, you have a great investor market fit for that domain. So it's a lot of things to think about in many different angles.
Yeah, definitely. Thank you for sharing that. I think I could also share a little bit about that. Even I think in North America, you kind of see venture capitalists more, I would say more distinguished, whereby you would have angel investor that go really early stage, they write smaller check sizes. And then you have the micro VC, the micro venture capital firm, which the fund size is approximately 20 million to 30 million. They write check sizes that ranges from 100,000 to 500,000, and they definitely focus on seed and pre-seed as a result of the check size. And then you go on to have the venture capital firm that can actually write bigger check size, and their investment could come in 1 million to 2 million. And a lot of these venture capital firms also make investment into later stage, what we call growth stage. And then the check size could be 10 million to 50 million. And I think, I'm not sure about Asia, whether the firm are actually that clear cut in terms of the investment, because sometimes the venture capital firm might have a funding from a family office, could have funding from a corporate organization, whereby they might have a strategic focus. And as a result of that, they might be more flexible in terms of the stages that they want to invest into. And I hope, we have answered your questions for Manuel. I hope that's how I pronounce your name. And I think, Edith, I want to go back to raise capital, because I like it because your website, it's so informative. It provides a lot of information for founders and entrepreneurs on what they should be looking for and how they should pitch to a VC. But you also mentioned that Raise Capital has a very unique operating model in which you run it like a software company. And then you have a daily Scrum with internal team. Can you tell us a little bit more about that, and why you think operating in Scrum mode is good for software and generally tech companies?
Yeah, like all of us are really geeky. So Scrum is a very geeky term for really managing software development. The old style would be, like, I came from Oracle Siebel, right? So that's also very old school. Like in the old days of software development, is everybody get together, big project plan, and you send everybody out to do their own thing. And everybody sort of, and then I have a classic example. I worked on the AT&T wireless, one of my customers implementing Siebel. It was a year and a half of deployment. I was working with Deloitte, and it was used for phone activation. And we were in Seattle, and I guess it's a combination of things. They turn it on, and they couldn't even turn on a phone. And AT&T Wireless literally could not operate for like 2 or 3 days, and cost $100 million and lawsuit to both Siebel and to Deloitte. So that is the classic disaster, when left hand don't talk to the right hand, and plus when you have like hundreds of people all working on a project. So this is really trying to address, hey, you know what? Sure, like you can do a lot of big things, but how do you actually make it into modular? Daily Scrum is basically a word for the geeks to have daily check-in, 15 minutes, just sort of promote transparency, but very short-term goal for that day. So everybody on the same page. We actually emphasize that not for our team, but for us. So every day, like today, I had a 4 o'clock Scrum with my other partners from the investment team. I say, hey, who did you talk to today? What are interesting deal? Who do you need to follow up with what? So we don't do partner meeting every week. We do it every day, but super, super short. So we all know who's doing what. I highly recommend it because it's such a fun exercise. We joke around. Yeah.
Do you
everything.
require companies to do the same?
We encourage them to do the same. Obviously, we don't like force them to, but it is such a good practice, I think, with everything you do in life. It's making things easier. So not everybody on the same page.
Yeah, that's definitely very helpful. I also wanted to touch on, so I would somehow when I'm screen sharing, I'm unable to see the chat. So I've disabled screen sharing, but I'm sharing my virtual background. And you talk about, this is what I got from your slide share. And I have a link here, if the audience is interested in visiting Edith, because she's been really good in sharing a lot of information for the founders and entrepreneurs. So Edith, you mentioned that an investor will not and cannot and would never invest in you the first time they meet you. So I think that's kind of like common sense, because it's kind of like dating. We can't just commit to a relationship in our first date. Then the question is, how do you get to the next date? How do you make sure that, how do you keep the relationship warm? How do you keep people excited so that there is a second date and a third date?
Yeah, I when I was writing this, I often we meet a lot of founders on a daily basis, and it just seems, it's surprising. So many of them is like, hey, so are you going to invest? And just kind of treat this whole conversation so transactional, and forget the fact that, Wendy, you're absolutely right. I think an investor and founder relationship is like a marriage. And once you put money in, you will be like legally, financially, emotionally bind with this team. And as much as, don't get me wrong, we definitely, even through Zoom, it doesn't happen often, but maybe once a quarter, we will have one founder we meet over Zoom. We're like so excited, like this is the guy. It happened this year, maybe one for me. I'm like, I talked to the guy, this is the guy, like we need to go after this guy. Rare, really rare. But even that, we often, because we do daily Scrum, right? And we will talk about how excited we are about the person, but we're like, we need to sit on this for 24 hours. Because there's always, because this is not, like no pun intended, but this is not a sprint. It's not just, I run really fast, I'm gonna get there. This is a marathon and a really long one. So we need to hold our excitement towards the person. And sometimes, like I said this, and this particular line is for the founders I was talking to, where your goal is just one thing, is to get the second date, the second meeting. And really, like the meeting number one is usually, I actually suggest better to have a conversation like this rather than show a slide, because I can't see you. It's hard for me to build a connection if I don't see your face. And then also sometimes it's as a rehearsal. A lot of founders should practice on what are the 2 or 3 key points that you want investor to remember and walk away with. And ideally, they should be the one, and hey, can I see a demo? Can I meet the rest of your co-founder? Can I, whatever that is, that sort of like should be your goal, where they want to learn more. And then really craft this message as you're not creating a movie in a half an hour conversation. You're doing a soap opera of many chapters. This is a chapter 1. So give it your all to the best, but don't give them the whole enchilada. So they're so overwhelmed. It's like, oh, this person is desperate. So it is an art, but also it is a science, because literally I would recommend everybody sort of think about what can you brag about, from tractions to the traction, all kind of metrics, to your team. Do you have IP? Your product is amazing, whatever. Write it down and then stack rank which one are the one that you're so most proud of, And sometimes could be, I have not even launched. I'm so proud of my team. So let's talk about that. My traction is so amazing. And oh my God, like within the last 6 weeks, I double, triple our sign up. Whatever that is, you have to kind of craft the message so you can talk about it intelligently.
Yeah. So I like the fact that you talk comparing movie to a drama series. So practically what you're saying is in your first meeting, share enough, but then leave a bit of thing left so that people can go from episode 1 to episode 2. Correct?
Yeah. Yeah.
But then
yeah.
there's a question from the audience that, and I think that's also very relevant. And I think I'm really glad this question came, kind of like somebody raised that question. And the question is, what should they wear to a VC interview or VC meeting? I don't want to put it as an interview because it's really a meeting for both of you. You need to like the VC at the same time for the VC to like you. So what should they wear? And does it matter?
Not to me. I mean, these days the beauty is, hey, I have you can be wearing anything underneath. I have no idea, or maybe nothing. Who cares? So, but I would say, my suggestion is, I mean, just be normal. But having said that,
normal is a very vague definition.
Well, Wendy, what you have is perfect.
Well, I mean, this is formal wear. This is like a suit. So I guess
okay.
let me put the question more specifically so people know. Should you be wearing t-shirt?
It's fine if you're a developer.
Is it better to wear a suit?
Well, we know that everybody's at home these days. If you wear a suit, will be like, I remember it happened maybe twice this year. Two of them, one wear a really nice shirt, the other one had a tie, and I'm like, wow, are you going somewhere? Yeah, I think it's okay. It's okay because we all know you're at home these days because of COVID, at least in the US. So therefore, it's okay not to dress up. You just need to be yourself, and you're comfortable. It's really about building relationship. And if you are not physically comfortable in whatever you're wearing, you mentally, emotionally, it's hard for you to be comfortable. So just be yourself.
Yep, I absolutely agree with that. I've seen entrepreneurs, in different outfits, but I think what attract the investors to the founders or the entrepreneurs, it's really the way you present yourself and the way you present your product and your service and the vision you have for your company. What problem are you trying to solve? And I think that really counts much more than what you wear. There's another question from the audience. The question is, how would you counter market opinions that say that VCs try to squeeze companies, especially at an early stage? Do you agree with these views? Are there bad apples out there in the VC world? What do you think?
Yeah, I think I definitely have came across where, especially I guess maybe in Asia, that happen more often than in the US, because in the US most of the data is quite public, or even like most of the finance vehicle or doing a safe note or KISS note, convertible note, a lot of these documentation are completely open. So, but I feel like maybe in Asia sometimes I have came across companies where like on the get-go in the seed round, they already sort of gave over half of the company away. A typical seed round, at least here, it could be, sell 10 or 20%. More than that is too much in my head. And so, and then also like most of the incubator, like YC or 500, they take, I think now like 7 to 8%. So therefore, a lot of these information are quite public. But I think in Asia, sometimes you have came across a very local, and I don't know like a lot of these investors that do that anymore. But I think in the past, when there's certain ecosystem is not as mature, sometimes, the local angel or investor may take a lot on the get-go because they can. And then the founder may realize when they're trying to raise an A and and B, by then the founder don't even own that much anymore.
Yeah.
So we definitely want to, we pride ourselves that we are founder friendly. Founder friendly is all kind of thing, right? You want to, have enough skin in the game, because trust me, like when they get to Series B or C and they own less than 10%, they're not going to motivate it to take
Absolutely.
this all the way. So
yeah,
it's a balance.
absolutely. I think there are definitely, I wouldn't classify them as bad apple, but I think it's important to understand what motivates the VC as well. If the VC intend to partner with the entrepreneur to build a long-lasting company, I think the VC will provide a reasonable terms. But if the VC is going in just for some, quick bucks, then maybe the motivation would be very different. And I think, Edith, you are so right to say, if you are raising, and this is for the audience, if you're raising money at your seed round and people are asking for, equity more than 30%, you really have to think twice, because that practically means that you would have problem, and your ownership will be very diluted when you try to raise Series B or C. And I think when Edith, you talk about 20 to 20%, 30%, I think that would be perhaps the market typical range, right?
Yeah.
Absolutely. Another question from the audience is, what is the criteria that VCs are looking for and evaluate before making an investment? And I think I'm glad that question came through, because this is just the same thing that I wanted to ask as well. You talk about traction. We talk about traction, we talk about founder market fit. And I want to bring people to the next slide that I have. So I have this, what we call customer traction roadmap. And I have the source. If you guys are interested, you can look into that. And this is a roadmap where how you should look at your customer traction at 3 months, at 24 months, and 36 months. And if I quickly, I'm going to say the first stage, it's the solution fit stage. So at this point, you build an MVP and try to find the exact solution to the problem. The second stage is the market fit stage. And you get an overview of your customers' behavior and try to give them maximum advantages by your service. And the final stage is the scaling stage. At this point, your product has become stable. You're a well-developed strategy. You're scaling to millions. Now you need to focus on strategies that engage your customers. And so, Edith, do you agree with this roadmap, or do you have more perspective to that?
So I'm very metrics driven. So I think regardless of your early or late, and by the way, like some of these questions that I would ask differently based on what you do, right? So B2B and B2C is also very different in terms of some of the things that I ask. Because I do focus a little bit more on enterprise and a lot of like SaaS related companies. So usually like I would look at it from like 3 or 4 different categories. And by the way, at the end of the day, it is founder is the most important. Market is very important. But market will always change if the founder is really clear in their head and they're relentless of making this successful. They are the one that's going to drive the ship anyway. So, and I love asking just to start with more on these buckets, because those are essentially the metrics for tracking the company eventually, even though they may not have it today. Let's say, for example, very, very early is all about acquisition, right? Are you generating enough lead? If you're working on a B2C company, I will ask you, what's your install base? And then when you go to activation, in the SaaS model on a B2B, it will be, okay, how many registered user if you're doing more online, or how many POC, like proof of concept customer, enterprise customer you're working with. They don't necessarily have to pay. That's not the key. Because in your graph, before you figure out product market fit, I don't actually care that much you even monetize or not, because there's no point to charge or figure out pricing if nobody want to pay anyway. So you may as well like figure that out. Doesn't matter B2C or B2B. And then on the mobile side, I usually, what's your daily active, what's your weekly active, monthly active? That's on the activation. And then after that, like we on the B2B side is what's the retention, means like how often do they come back to use these tools? Is it daily, weekly? When they do use it, how long do they spend time on your tools? That same thing apply for consumer. And then we talk about potential monetization, because the way to make money these days doesn't matter B2B or B2C. It's pretty much all figured out, right? Either you pay a monthly subscription, or is it usage, or is it enterprise license, or is it advertising, which you don't charge anything, but somebody else pay for all this, or virtual goods, like if you're coming to the TikTok and Douyin type. So it's quite there already. And plus there's always somebody else already doing it. So we don't need the founder to actually make money, but we need them to have a clear head. So I enjoy those sort of conversation when I vet or look at a company, not because they have all the answers. Sometimes is what they admit they don't know, review the person, like in terms of, then you know, like they would know when to ask for help. Otherwise, let's say this morning, right, we look at the deal and, hey, by the way, don't get me wrong, good for them. And because I look at a lot of developers' tools, so often a lot of these companies will launch it on Hacker News and they get a lot of like votes up. And now nobody's paying anything, okay? And people just sort of downloaded their piece of software and start playing with it. But a lot of developers have a lot of pride. Oh my God, I'm like #1 on Reddit or #1 on, I'm like, that's great social proof, but it's not enough to build an amazing company. Mm-hmm. So sometimes you sort of have to, and I have another thing, you definitely can call me on it. As much as I'm very conscious about brand building, and sometimes I do interviews, PR is not attraction for a startup. Just because you get a lot of award or you get covered by CNBC is not going to make your company successful. So we wanted to like find a founder where like he or she is very level-headed, you know, and then, but you can only tell by just conversation to learn like this, you know, the character of the person.
No, I think that definitely you're sharing some very practical advice to a lot of the people here. I think that's very helpful. Another question is probably more detailed. I'm not sure if we can even answer to that detail, but I think it's worth exploring. It's so the question is from a founder. They are a startup that's offering next-gen transportation, building infrastructure across Southeast Asia, introducing unmanned aerial vehicle. So they'll be offering a convertible note to raise about 13 million. They have an annualized ROI of about 30%. ROI has a 250% growth, I think. Investment gain of 3.2 million US dollar. So that's based on a very conservative calculation. So the question is, how do they predict the right market cap for VC exit strategy? Should it be 2 times, 3 times, or 10 times of revenue of a completely new for a completely new industry? What do you think of that? I think this is really talking about valuation for companies, especially when you don't have a benchmark or you don't have comparables. For the founders who's on this call, I think it's great that you guys are so smart and basically trying to figure it out on the investor they have. Oh, like if this and this, you're going to make this. Don't do that because like I don't want to evaluate how much money I will make. I want to evaluate how big your company is going to be. And then it's up to us. By the way, if we only make 10x, we wouldn't invest actually, because the math is actually about, I want every single investment to be able to return my fund, right? And trust me, we have an extended calculation of all sorts of scenario, A, B, C, D, F, G. But the key thing is that
you as a founder, if we're talking about valuation, obviously transportation is a hot thing these days. Just look at Tesla. You already have one of the best comp where, of course, it takes a lot to, or the NEO. So the comp is there, but there's also components on the next gen transportation. Maybe you're doing sort of the mass planning of navigation for a city, right? Or you're doing LiDAR, or you're doing whatever the components of it. Probably, or if you're a particular region, that's probably a comparable in the US or China. And then you could literally say that you can be that, but in this region, that could be interesting, and draw those as comp to potentially as that. And don't quote me on it, but obviously most of the time my rule of thumb is I go on Crunchbase, I look at how much they've raised, and I basically treat that maybe 20% or 30% of the valuation. That's usually my guess. That's how you could potentially sort of project, okay, at seed stage, Tesla raised X. Okay, it's Elon, so he probably raised a lot. But let's say it's not Tesla. Let's say some other, founder first time, they have raised this at this. You can kind of get a pretty good comp just from research.
Yeah. I think Tesla, it's an exception, so we might not want to rely on Tesla too much. But I think the fact that you gave those examples, those are very helpful. Another question we have is, this is interesting. I think, thank you for the question. It says, curious to learn how VC stay positive, knowing that, not all startups you invested will make it through. So how do you stay positive?
Because I'm a positive person. But having said that, I do remember at the very beginning when I was running, so I have a small fund at 500 that did really, really well. But because I did early stage, and yeah, like most of my return was from 2 companies. But those 2 companies, one is actually exceptional, took 3 years. The other one took 5, 6. And even like work longer before it happened. So at the very beginning, like as a fund manager, you look at the performance, you're like, oh my God, like when is anybody going to raise another round? You get nervous. You're like, did I make the wrong decision? Oh my God, like what's wrong with them? Like, how come they're not doing X, Y, and Z? But you can't get upset with things that is not there. You can only celebrate things that's happening. So I think for all of us, if we're not happy with what we do, we shouldn't even do it. Like it will be hard, it will be a struggle, and it shouldn't be. Yeah. This is such a fun and privileged work job, but I don't treat it as a job. I really, really enjoy being able to interact with so many amazing people who want to change the world. Yeah. But of course, I get super nervous. I'm like, what is? But then you have to sort of tell your little self that, hey, you can't be like that, because otherwise you can't be the rock for your founder. So we have to stay strong.
I like it how you describe it, but at the same time, I think another way to look at it is a venture capitalist. It's all about portfolio management. At the end, if I intend to invest into 10 companies, then I would need to design my portfolio of the 10 companies in a more strategic way. And I know that some companies, the idea is very early stage, the risk of failure is very high. And I already factor that into my portfolio setup. So when it does fail, it's all within my expectation. So that's the reason why we kind of balance risk and return. And I think that's one way to stay positive as well. And I hope that answered this audience question. Another question we have, and I know we're coming up to 7 p.m. We have to end the event soon, but I'm just going to quickly ask this question and ask for Edith's quick answer. It's Edith, what do you think about the current SPAC market impact on your investment? SPAC, SPAC.
Yeah, it's funny. I actually wrote about it a couple of weeks ago on my newsletter. In the newsletter, I actually talked about, it's crazy. It's just this boom is too good to be true. You're talking about like Jay-Z, Serena Williams,
Yep.
Steph Curry have a spec. Like,
I know.
when these, and also like earlier this month, Robert Pink has launched 2 spec. Because everybody under the sun in the valley are doing something. It's almost a little bit too good to be true. And of course, we have spec men like Shamath, which is crazy. So this year in 2021, there's already over 200 spec that raised 73 billion. This is all on my newsletter. It's almost already the whole volume for last year. This is crazy. I think my whole thing is, I don't. Part of me is like, I don't want it to burst, but I do think that every single spec, usually when they get set up, they have a finite deadline. Usually I think 24 months to acquire a company in the target vertical, right? So could be biotech, it could be, you know, SaaS or enterprise. So the clock is ticking. And sometimes, and this is an acquisition event. So it doesn't have, it's not the same scrutiny you will go through with going through a IPO. So what I am worried about is certain companies may not actually be healthy enough to go public. And once you go public, everything is, you know, and just look at Nikola, which is sort of the autonomous truck that went public through a SPAC, but it turns out not doing well. So I don't want to see that happening, but I do think it's a really great thing for early investor like us or the founder. Now, in addition to traditional IPO, M&A, direct listing, you're SPAC. And in some sense, the timing on going through this is much shorter. It's great news for the founder. But I think all of us should be very conscious about, we need to have the same diligence with growing our companies. Doesn't matter you're going through SPAC or not, because one way or the other, they will find out, like when you go public.
Absolutely. You know, Edith, I wanted to thank you for your time today. Before I end the event, I always love to share food for thought for the audience. The last time I talked about a 1,000-year-old mochi shop in Japan. And I think this time I just want to end our event with a quick story about traction and pivot. So this is a story about pita chips, and it's very popular in North America. And this story is also very commonly known in North America. For people who are in Asia, if you're interested, you can definitely check it out. So the company is basically started, you know, to sell pita sandwiches, but they pivot to sell pita chips, and very quickly. And then the sales reached about 1 million. And then in about 4 years, it reached 65 million. And at that time, they sold it to PepsiCo for 243 million. So I think this is a really interesting story to look into, because when they started to sell sandwiches, they never thought that pita chips become actually their main product. And they kind of pivoted as a result of that. And then the traction from the customers was so receptive, then they decided to really scale up selling pita chips. And I think this is a very interesting story. If you guys wanted to learn more about it, feel free to Google it. So Edith, thanks again for your time and for your very insightful sharing. And I think I'm getting a lot of good feedback from the audience, and they're very appreciative of your sharing as well.
Yeah, thank you for having me.
Thank you. So this will be the end of the event. Thank you everyone for joining.
Bye.
Bye-bye.